Ladies and gentlemen, good day and welcome to the Q2 FY23 earnings conference call of Healthcare Global Enterprises Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. Now I hand the conference over to Dr. B.S. Ajay Kumar, Executive Chairman of Healthcare Global Enterprises Limited. Thank you, and over to you, sir.
Thank you very much, and a warm welcome to you all. At HCG, we are very happy with our performance for this quarter. We'll, of course, hear all about it in the next few minutes from our CEO, Raj Gore, and CFO, Sriram. Meanwhile, I would like to take this opportunity to provide some information how HCG chain of dedicated cancer centers is consistently moving up the value chain of high-quality clinical care powered by high-end technology. Recent times, cancer is fast moving towards precision therapy, which explains why outcomes have improved significantly, and more so over the last few years. Let me take a few minutes to elaborate on some new technology at our Center of Excellence Bank.
So sorry to interrupt, but your audio is breaking up in between, sir. Your voice is going in and out.
Yeah, I can do. I would like to take a few minutes to elaborate on new technology we have launched at our Center of Excellence, Bangalore. This technology is ethos from Varian, and it helps perform adaptive radiotherapy. Adaptive radiotherapy is something...
Dr. Ajay Kumar? So sorry to interrupt, but your audio is breaking up in between, sir.
I don't know what else I can do here. Hello? Can you hear me now better?
Yes, this is better, sir.
Hello?
Yes, sir, please proceed.
Just to repeat myself, I will take to elaborate technology we have launched at our Center of Excellence. This technology is ethos from Varian.
Sorry, Dr. Ajay Kumar. Still your audio is breaking up once again, sir. So if you can...
I don't know. Can you go to the computer room? Just set it up here and cut it down there.
We request all the participants to please stay connected while we check the audio connection for the management. Ladies and gentlemen, the line for the management is reconnected. Over to you, Dr. B.S. Ajay Kumar.
Thank you very much. I'm sorry about this disturbance. As I was saying, I'd like to take a few minutes to elaborate on new technology we have launched at our Center of Excellence, Bangalore. The technology is called ethos from Varian, and it helps perform adaptive radiotherapy, and is one of the first few in the world we have established here now at our Center of Excellence. Adaptive radiotherapy is something which continuously probes deep into the tumor and intelligently adapts the treatment to the tumor configuration using a AI platform. We can use the actionable information generated from it in the treatment of subsequent patients. Our area of interest is to collect proper data and see how a tumor responds to the treatment. This technology will finally help us answer some critical questions like when do we get a complete remission? How long should the treatment span be? Questions that have challenged radiation oncologists for several decades. Being a leading cancer care provider, we are deeply engaged in academics and research, and I would like to highlight our seminal paper publications. Talking of academics, we are very proud to announce that we have fellowship programs of over 170 fellowships and different DNB programs, and all of our programs are in high demand, not only in Bangalore, but also importantly in Tier 2, Tier 3 cities. As we all know, in the past, it was very difficult to ensure high-end training in Tier 2, Tier 3 cities, and also to find personnel who are willing to relocate and practice there. But we are very fortunate that now even in Tier 2, Tier 3 cities, like even Ranchi, Vizag, Karangol, we have fellowship programs, DNB students for training, which undoubtedly augurs well for the community of these regions. We take research very seriously. Till date, we have published close to 756 research papers. For October alone, we have 9 publications. And more importantly, a significant number of them have been a podium presentation. This clearly reflects of high quality of work, which is one of the best in oncology globally, not just in India. We have some doctors who have also written key chapters in textbooks. We have one who have won Best Paper awards and been in top in the clinical research abstracts. Recently, we participated actively in a radiation immune conference where we won one of the best awards for it globally. This is just a gist of our achievements in academic and research, and going forward, we will continue to ensure a seamless integration of clinical services, academics, and research such that all our breakthroughs serve the large purpose in the form of better treatment outcomes and improving the quality of life for our patients. The future is very bright for HCG across all aspects of cancer management. We will continue to strive hard to make cancer a chronic disease and bring higher success to HCG. Thank you very much. Now I hand over to Mr. Raj Gore, our CEO.
Thank you so much, Dr. Ajay. A very warm welcome to all the participants on the call. We are delighted to share yet another quarter of good performance. We've been delivering growth on year-on-year basis as well as sequentially for the last 8 consecutive quarters now, and this quarter is no different. We're happy to report another strong financial performance for quarter ended September 2022. Our consolidated revenue for Q2 stood at 420 crores, a growth of 19% on YOY basis. This strong revenue growth, coupled with our focused efforts on cost rationalization, have resulted in year-on-year margin expansion of 130 bps, leading to adjusted EBITDA margin of 19.3%. Our adjusted EBITDA for Q2 FY23 stood strong at 81 crores, a growth of 28% over Q2 FY22. As a result, our Q2 FY23 profit after tax on a pre-Ind AS basis stood at rupees 10.5 crores, up by 137%. Over the last few quarters, we've been regularly informing you about our efforts to drive growth on several fronts, like enhancing our clinical services portfolio, increasing our clinician bandwidth, and our go-to-market initiatives to increase reach online and offline, retail and institutional accounts, domestic and international fronts. We are making encouraging progress on all these fronts, resulting in a steady growth in new patient registration, higher utilizations across all modalities of treatment across metro and non-metro markets. While our mature centers continue to show higher than market growth rate, the growth strategies implemented for the emerging centers have started showing promising results. Kolkata and Mumbai centers have grown by 40% and 30% respectively on year-on-year basis in current quarter. I'm happy to highlight here that our Jaipur center has more than doubled its revenue on a year-on-year basis, with more than 25% EBITDA margin. Our 2 linear accelerators there are nearing its full capacity utilization, and we will be commissioning 1 more linear accelerator early next year. Our differentiated and specialized cancer care, along with strong brand positioning, have enabled us to attain leadership position in 13 out of 18 locations where we are present. Going forward, we will continue to invest in HCG brand to make it the most preferred choice for cancer patients across India. We are very optimistic of improving our market share and strengthening our leadership position going forward. Now I would like to hand it over to Srini, our CFO.
Thank you, Raj, and very good morning to everyone. We have uploaded our Q2 FY23 financial results and updated investor presentation on the stock exchanges and company's website, and I hope everybody had an opportunity to go through the same. We are delighted to share that we have been able to grow our revenues ahead of the industry growth due to the trust and brand created for HCG. On the revenue front, our consolidated revenues for Q2 FY23 stood at rupees 420 crores as compared to 350 crores in Q2 FY22, a growth of 19%. Our revenues for H1 FY23 stood at 828 crores, a growth of 23% year-on-year. Revenue split between HCG and Milann stood at 96% and 4% respectively for Q2 FY23. Revenue growth for HCG stood at 21% year-on-year, and for Milann, excluding for COVID revenues in Q2 FY22, stood at 15% year-on-year. As mentioned in slide 25, revenue from the mature centers stood at rupees 309 crores, a growth of 19% year-on-year basis for Q2 FY23. Revenue from emerging centers stood at 95 crores, a growth of 26% on year-on-year for Q2 FY23. We are delighted to state that our emerging centers are inching towards maturity and are seeing good traction across geographies. I now request your attention to slide 26, where we have disclosed our operational parameters across our mature network and emerging centers for Q2 FY23. Our company-wide AOR stood at 66.4%, and AOR for mature versus emerging centers stood at 65% and 69.9% respectively. Higher occupancy for emerging centers is due to 72% of beds were operational in new centers. AOR and capacity beds stands at 57%. Our ARPOB on company level stood at 36,914, and our ARPOB from mature centers stood at 39,684, and for emerging centers stood at 30,145. The degrowth of AOR in our emerging centers was majorly attributed to a couple of centers in the emerging markets growing at a very fast pace with higher share of institutional business as compared to business from out-of-pocket patients. However, we believe this is a temporary phenomenon and should stabilize, and we should see increasing ARPOB from our emerging markets as well. Across geographies, we have given our revenue breakup in slide number 27. Jaipur grew by 205%. Revenue from Rajkot grew by 80%. Mumbai grew by 30%. Bangalore Center of Excellence grew by 35% year-on-year for Q2 FY23. Our Milann business is also doing well. Revenues have increased by 15% in Q2 FY23 on YOY basis, excluding the vaccination revenue for Q2 FY22 on a like-to-like basis, and new registrations grew by 14%. On the EBITDA front, our consolidated reported EBITDA stood at 74.7 crores as compared to 61.7 crores in Q1 FY23, a growth of 21%. Reported EBITDA for H1 FY23 stood at 146.9 crores, a growth of 30% year-on-year. Adjusted EBITDA for Q2 FY23, that is After adjusting the one-time value creation cost and adjustment of ESOP expenses stood at 81 crores as compared to rupees 63.9 crores in Q2 FY23, a growth of 28%. Adjusted EBITDA margin stood at 19.3% as compared to 18% in Q2 FY22, a growth of 130 basis. Adjusted EBITDA for H1 FY23 grew by 39.6% year-on-year with margins at 18.9%, a growth in margins of 230 basis. We have also given bifurcation of EBITDA across mature and emerging centers, and I would request the participants to view slide number 25 for further detail. On profit after tax, we have been delivering positive PAT for the last 3 quarters now. PAT for this quarter stood at 7.4 crores as compared to 0.8 crores in Q2 FY22. H1 FY23 PAT stood at 13.4 crores as compared to a loss of 8.7 crores in H1 FY22. Our PAT, pre-Ind AS adjustments for Q2 FY23 stood at 10.5 crores as compared to 4.4 crores in Q2 FY22. PAT for H1 FY23, pre-Ind AS adjusted, stood at 19.7 crores as compared to a loss of 1.5 crores in H1 FY22. ROCE for matured networks stood at 20% annualized for H1 FY23 as compared to 24.8% in FY22, a growth of 460 basis. ROCE before corporate allocations for matured centers stood at 24.8%. ROCE for emerging centers stood at negative 4.9% annualized for H1 FY23 as compared to negative 8.3% in full year FY22. This is again an improvement of 340 basis. ROCE before corporate allocations for emerging centers stood at negative 0.9%. Our net debt position, excluding capital leases, as on 30th September, stood at 211 crores as compared to 190 crores as on March 31st, 22. Our expansion of existing facilities at Ahmedabad, Phase 2, and Whitefield extension of Bangalore COE is on track. Total planned capex for Ahmedabad is 85 crores, expected date of operations being Q1 FY25, and for Bangalore COE is 25 crores, expected date of operations being Q4 FY24. With this, I would now like to open the floor for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2.
Oh, yes.
Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The first question is from the line of Karan from Sonara. Please go ahead.
Hello. Hi, sir. Am I audible?
Yes, you are. Thank you.
Yeah. Sir, my first question would be on the 5 crore consulting cost that we booked in Q2. Can you just, sir, give us some color on where this 5 crore consulting cost has been spent and what kind of benefits are we going to see from this? That's my question number 1, sir. And my question number 2 is that we see some sequential decline in our emerging centers revenue and some decline in ARPOB as well. So can you just give us some more color on how do we see this shaping up for us and what exactly are we doing in our Bombay and Kolkata center? And, we said that we're going to get new talent in and a new surgical head over there. So can you give us some color on both of these centers as well? Thank you, sir. That's it from my side.
Thanks for the question, and I'll take the first question. Regarding this 5 crores that we are talking about, this is regarding the value creation activities that CG has embarked upon. We are working on two things. One is, how do we drive productivity and efficiency across the system? That is one line of activities. And the second area that we are working on is on the digital front as to how we can use technology platform and digital platform to drive revenue. These are the two activities that we have embarked on. And as we speak, the progress is happening, and the cost of 5 crores is towards these activities. In terms of your question, in terms of what kind of benefit this would kind of entail or result in, we expect this should result in the next year a profit overall EBITDA improvement of about 100 to 150 bits basically.
Got it, sir.
Margins on the EBITDA margin.
Got it, sir.
And the second part of the question, Raj would like to answer.
So if I understood your question, one was about emerging centers ARPOB. As Srini mentioned in his opening remarks, that when you open a new hospital, the first goal is always to get the utilization up on different modalities. So usually, you drive more institutional business, and quarter on quarter that mix sometimes can change between different hospitals. We're not concerned about it. We think it's a one-off, and it will get back on track going forward. Regarding, can you repeat the third question that you had?
Yes, sir. So on our strategy in both in Bombay and Kolkata center, sir. So what exactly are we? Yes, sir.
Yeah. So as discussed in the past also, Kolkata and Colaba in Mumbai are our newest centers. As soon as COVID went away, we started doing our go-to-market initiatives. We started increasing our clinician bandwidth, improving our clinical services portfolio. Those are showing results. As I mentioned in my opening remarks, Kolkata has grown 40% year on year. Mumbai hospitals have grown 30% year on year. We're very confident that in subsequent quarters we will continue that growth momentum.
Okay, sir. So just to follow up on the consulting costs, will we see this 5 crores continuing in Q3 and Q4 as well? Or will this now start trending on a downward trajectory in Q3, Q4?
So it will start coming down by end of this financial year. We expect it to go away. Yeah. So in following year, next financial year, this will not be there. That's why we identified it as a one-time separate expense.
Okay, sir. Thank you. That's it from my side.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Kaustubh Pawaskar from Sharekhan by BNP Paribas. Please go ahead.
Yeah, good morning, sir. Thanks for giving me the opportunity and congrats for good set of numbers. So my question is on margin front. So of the total material medical equipments, how much is the imported equipment? Because what I'm trying to understand is because of this rupee depreciation, will it have any impact on your cost element, and that might result in margins coming lower in the coming quarters?
No, as far as the rupee is concerned, there are two things. We don't see any margin impact because the agreement we have with some major suppliers or, as we have already indicated in the past, or the pay-per-use model. So that will, and also we do earn a lot of foreign exchange, which is a natural hedge. So because of these two things, we don't see any margin impact from the procurement of the equipment.
But secondly, we do not have any dollar exposure.
Okay, okay. And just to understand the question a previous participant asked about the RPOP remaining flat. So this is like a one quarter this impact. You might see RPOP coming in better in the subsequent quarters.
Absolutely, Kaustubh. Thank you for asking that question. See, emerging centers is a bucket. You also have Mumbai there. You also have Kolkata there. Kolkata RPOB is almost close to 50,000, per day. Mumbai RPOB is in mid-50s, right? So as these three centers, two in Mumbai and one in Kolkata, continue to grow in terms of their contribution to total revenue of emerging centers, the RPOB will start going higher and higher in subsequent quarters. In addition to that, these are also the two locations where we will get, higher international business that compared to other non-metro locations. So that's another lever that we have to drive price realization as well as RPOB.
Right, sir. And one last one, if I can.
Usually, what we do, Kaustubh, the playbook for new hospital commissioning is you open the hospital, first you go for footfall, first you go for higher occupancy, higher utilization on different modalities. You create a significant number of treated patients to drive word of mouth, and then you start optimizing different mixes to drive your realization RPOB margin. So we are in that journey right now.
Right, sir. Thanks for the understanding. So my last one is on, as you said in your initial comments, that patient registration is one of your key driver in terms of occupancy. So on year-on-year basis, can you give us some idea what was the increase in the patient registration? Because word of mouth and whatever technology you are bringing in, so that will also help you to have more and more registrations going ahead. So any understanding on how it was in this quarter and any expectation in the quarters ahead?
Yeah. So on a YOY basis, last quarter we saw NPR registration growth in lower teens, about 11-12%, at a network level. Obviously, it will vary from the geography to geography, maturity of the center.
Okay, sir. Thank you.
We are not seeing the full impact of our other initiatives like what Raj and Srini mentioned. That impact is still to be seen in the last quarter at the beginning of the next year.
Okay, sir. Thank you for the understanding and all the best for the future quarters.
Thank you.
Thank you.
A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Dhara Patwa from Smiths Limited. Please go ahead.
Yeah, thanks for the opportunity. Sir, I just wanted to understand how much time does the emerging centers take to become mature? When can we expect East India hospitals to deliver a margin of 15% plus? So that's my first question, yeah.
Thank you, Dhara. Sorry if I've got the name wrong.
Yeah, it's right.
Now, this is a bucket, right? So different hospitals are at a different, maturity stage. I gave an example of Jaipur. Now, Jaipur is already, double the revenue, has, started delivering EBITDA margin 25+%. So, Borivali, similarly in Mumbai, is delivering in mid-20s EBITDA margin. Kolkata is our newest center. We expect it to start breaking even early next year, and then we will continue to grow that margin. 15% is probably the subsequent year, following the next year, because it's that's our newest center.
Right. Okay, sure, sir. Got it. And wanted to understand, 88% of our revenues comes from oncology. So do we have any approx breakup, like how much of that would be from medicines and how much will be from the surgical procedures?
Okay, split by radiation.
Right.
So, yeah, so usually we break our business in 4 big buckets, right? One is your consultation and diagnostic, which is about 20% of our top line. Medical oncology, which is chemotherapy, immunotherapy, etc., that's about 35%. Radiation oncology is about 20%, and surgical would be about 25%.
Okay, sir. That's it. Thank you. That's it from my side.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Karan Vora from Goldman Sachs. Please go ahead.
Hi, this is Shyam Srinivasan. Thank you for taking my question. Just one on slide 11.
Hi, Shyam.
Maybe I have not seen the slide before, but it seems very interesting. Doctor, can you just explain, the non-metro versus metro? I think many of the other healthcare companies now are talking about going into non-metro locations, but you seem to have made a pretty decent job of it. So just if you could explain this slide, please.
So, Shyam, that slide, what we are trying to say is, look, healthcare opportunity in India, demand-supply gap, accessibility, availability, we all know about it. But I think the bigger problem we have in this country is disparity, right? Most of our healthcare supply is in metro, big cities, state capitals. The real need, to provide quality healthcare, bigger need to provide quality healthcare is outside big cities. I think this is where HCG has a unique business model. What this slide basically says that we have 13 locations which are tier 2, tier 3, tier 4. Places like Ongole are like 2 to 3 lakh population. Rimoga, again 2 to 3 lakh population. So, almost tier 4 kind of a category. Now, out of those 13 locations, 11 locations we have a number 1 market leadership in oncology. The way we have the way the business model works is, the result of our business model is, out of those 13 locations, we are delivering, EBITDA margin in the range of 15 to 28%. Some hospitals, the lower side is 15% and the higher side is 28%. In terms of ROCE for these 13 locations, the range is between 15 to 24%. That's because, one, we have an early mover advantage, first mover advantage. Second, our unit economics, we are about 20-25% lesser cost in terms of our capex in these markets. These markets, our operating cost also tends to be lower, and then we go for more institutional business to drive higher volumes at relatively lower price points to make this model work for us. I think, that if you look at, all the healthcare players in India, I think HCG is probably the only one who has made its model work in different tiers of cities in India, delivering pretty much similar EBITDA margins as well as ROCE returns across our locations.
Just to following up there, Raj, just on the payer mix, which you also highlight, right?
Yeah.
You take on more institutional, even government scheme patients. So ROC, you're mentioning greater than 15% still, but is there no worries around receivables from the government, and how do you navigate that?
Yeah, so look, I think when it comes to receivables, the trick is, get your processes in terms of documentation, submission on time, and follow up, get that discipline in place. Lot of these schemes have gone now in terms of their processing
online. You have portals to submit. There is better visibility coming in these channels. In fact, our DSO is consistently going down over last quarters for this particular payer mix in these markets. So I think on these institutional channels, and we made it work for us.
I think to add to what Raj mentioned, Shan, this is Srini here. Yeah, while there could be some government challenges in terms of collection, but as Raj rightly pointed out, our net DSO is kind of coming down quarter on quarter. That's point number one. And happy to say that, this quarter ended September was our highest collection month in terms of overall receivables as well. So while there are challenges, but, there is clear focus in terms of how we drive collection and ensure that, we stay on board.
Got it. Thank you. And last question, again, just back on RPOBs. So I'm talking now only just matured center RPOB, right? I think remember last quarter or before, we did a rationalization exercise to look at how our prices are versus competition. And if you are a leader, we have taken some price increases up. Is there something that, I know it used to be a 12-18 month exercise, but do you think that could be a lever in the next 12-18 months also that you could do the rest of the portfolio where you have not done that exercise?
Absolutely. Just to recollect what we informed last time, is we started that initiative from our Bangalore center. And we are in process of rolling it out to rest of the locations. In Bangalore center alone, we've had about 25-30 basis points impact, on an overall P&L, EBITDA margin of the company. By just rolling out this initiative in our Bangalore market. Now we are rolling it out, as we have mentioned earlier. Srini also covered it in his remarks, that we are looking at about 150 basis point improvement in our EBITDA margin, by end of once we finish the rollout of the initiative. Obviously, it will also help us to drive RPOB. Our mix is very different, right? Because our locations are Bangalore market, Ahmedabad market, which are our core home markets, where we have dominant market position for a longer period. Our RPOB is 75,000, around 75,000 per day. Mumbai, as I mentioned, is in mid-50s. Baroda is in mid-50s. Kolkata is almost close to 50. So as our centers start getting at a higher utilization level, we'll continue to optimize mix, drive, price realization, pricing as a lever, and we'll continue to increase, grow our RPOB in the right direction.
Got it, Srini. Just following up there. So that 150 is like a 12-18 month journey, or how should we look at that? Just from this activity.
So we've already got some impact. We feel that at a quarterly level, early, I think first quarter of next year, we start seeing that impact in our P&L.
Got it.
We are expecting the full rollout, implementation of these initiatives across different hospitals by end of Q4 of this year.
Got it, Raj. Thank you and all the best. Thank you.
Thank you.
Thank you.
The next question is from the line of Abdul Qadir Puranwala from Elara. Please go ahead.
Yeah, hi, sir. Just one question. So could you please elaborate on the status of hi, sir. On the status of our expansion plans at Whitefield and Ahmedabad, because if I see sequentially, the capex incurred this quarter, I mean it's flattish. So just some color on that.
Yeah, in Ahmedabad, we have started the new project. The work is going on. We expect the transition to happen by October of 23. And, so that is going as planned. As we know, there are also certain transfer of technology, linear accelerator, all of this will happen. So we hope that by October it will all be completed. It will be fully operational. Regarding the Whitefield, we have just got the approval from the local authorities, the BBMP. So for the plans have been approved.
Got it, sir. Thank you.
And we expect the project to be completed in about maximum 2 years. That is when 18 to 24 months. So once the construction work starts. Okay?
Understood. Thank you.
Thank you.
Thank you.
The next question is from the line of Naman Bansali from Perpetuity Ventures. Please go ahead.
Yeah. Hi, sir. You previously talked about some diversified revenue from various modalities. So could you please help me understand the margin dynamics in that region? That is, the margin dynamics in the medical oncology, surgical oncology, in that part. And so that's my first question, right?
See, we do not give margin dynamics by service line. So that is why we give it at a consolidated level, and the overall contribution margin is a good indicator of our overall business.
Okay. And the second question, yeah.
So once your question is done, maybe request you to mute your answer from your end, please.
Yeah, sure. So my second question was on the unit economics. So you talked about 20% lower cost. So what is the capex per bed or capex per center which you incur versus the industry?
So capex per bed and okay. Let me put it this: as far as you're looking at tier 2 centers, right?
Yeah.
So, again, I would like to differentiate here. We are not necessarily bed capacity is not necessarily, the main driver for our growth. We have 4 modalities: OPD, diagnostic, chemotherapy, medical oncology, radiation. These are all daycare, or outpatient services. Only surgical, largely, is our inpatient. So we do not. That matrix is not necessarily, relevant for us. However, if I have to give you a ballpark, our, cost per bed, in metro cities will be about 65 to 75 lakhs. And in tier 2, tier 3 cities, it will be about 50 to 55 lakhs for a hospital size of about 80 beds.
Okay, got it. Thank you.
Yeah. I just want to address the previous question that we had. See, the reason we do not give margin by modalities is because it's not necessarily a driver for margin improvement. A cancer patient, when a cancer patient walks in, we do not have a choice to the modalities that you need to treat that cancer patient. It's not a choice. It depends on what type of cancer, what stage of cancer. So that's not necessarily a controllable variable for us. It's more of a it depends on what the patient's state is. So it doesn't make sense to track it that way, because it's not really a variable that you can control or optimize or drive.
No, just to add to what Raj said, in a multidisciplinary approach, what we have, the team decides whether the patient should undergo chemotherapy or radiation or surgery or an integrated approach. Nearly 60% of the patients end up having all 3 modalities of treatment. So you cannot really break up into which is a high margin, which is no margin. We have to look at it at a consolidated level. For us, what we try to look at is per patient, new patient, what is it cost to do certain treatments combined. So obviously there are ways a contribution factor may be more from radiation. So we do look at all that, but it is not the driving force for us to do the right treatment for the patient.
Thank you. The next question is from the line of Deepthi Kotari from Kotari Securities. Please go ahead.
Hi, sir. So my first question was that we have been increasing in terms of revenues and margins, have also expanded over the last 6 to 8 quarters. However, we are still not a high PAT generating company. So what is your sense on PAT going forward?
Yeah. Thanks for this question. If you go back to my earlier part of the thing, I talked about, PAT before Ind AS impact. So let me set the context here. If you look at it, my PAT at a pre-Ind AS level is close to 10.5 crores, and if I adjust for the one-time impact that we talked about on value creation, overall PAT at the pre-Ind AS level is 14 crores. So let me explain a couple of nuances in this. Point number one, basically because of the Ind AS impact, the long-term lease rental model that we have, because of that, my post-Ind AS PAT is getting depressed because of the initial year of the lease rentals, given the equalization of lease costs. But having said that, over a period of time, especially at the midway point, this should kind of reverse basically. So you got to look at the pre-Ind AS impact as far as PAT is concerned. And secondly, I did talk about the value creation activities. There is one-time cost of 5 crores that is sitting, which is in the EBITDA and kind of flowing into the PAT number also. If we exclude the impact of that, my PAT should look better. And last but not the least, since you asked about how is the future looking like, we are currently at a tax regime of 35%. We are going to be moving to a 25% tax regime next year onwards. So putting all these factors together on a pre-Ind AS PAT basis, my PAT is at about 14 crores for Q2 FY23. That's the way I would put it.
Okay, sir. Thank you, sir. That helps a lot.
Thank you. The next question is from the line of Aditya Khemka from InCred PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity. Ironically, my question, sir, is exactly the opposite of the previous participant. So I see we have a lot of intangibles, and obviously we do acquisitions and alliances that creates intangibles. But I don't see a lot of amortization of that intangibles, as in we are amortizing, either not amortizing, or if we are amortizing at a very, very slow pace. And I understand the higher the amortization, the more depressed the PAT will be. But, as an investor, we don't really care about PAT, we care about cash flows. And the cash flows has actually been really healthy for the past 4-5 years, and they continue to be healthy. So my question to you is, why don't we amortize intangibles at a faster pace so that our ROCs can look better, and we get tax exemptions, tax break on our intangible amortization, and that helps us save cash. End of the day, any company's job is to generate cash, and PAT is just a number.
Yeah, I understand. It's a good point that you are bringing up, and it's quite interesting that you call it out. I also appreciate the fact that, you talked about, positive cash flow in the last few quarters, which is a good thing. Yes, it's getting the right balance, basically, getting the right balance in terms of, amortizing the intangibles. We are not aggressive. At the same time, we are not very slow as well. We are doing it as per the law, as per the procedures, basically. And, intangible comes only in the case of, new acquisitions. In the last few quarters, if we had seen, we had this lab acquisition, we had this Chichurayu acquisitions. Those have kind of created those intangibles, basically. But having said that, it would be amortized on a basis that allows as per the Companies Act as well as per the accounting standard.
Yes, sir, but your accounting standard actually gives you a very large range of amortization. It is 10 years to 50 years that you can use to amortize intangibles.
I agree.
Yeah, so my point is that instead of using 50 years or 40 years, you could do it over 10 years.
See, our philosophy is, our amortization happens anywhere between 5 to 8 years, basically. I think that's the kind of trend that we have been doing, and that is the way we would move forward as well.
Fair enough. My second question, sir, is regarding the multi-specialty and the super specialty makeup of our company. Obviously, I'm keeping Milan aside here, given that it's very small in the context of things. But, the multi-specialty hospitals, your super specialty obviously seems to be doing phenomenally well. On the multi-specialty side, what is the plan? Do we plan to remain a company which is both multi-specialty and super specialty, or at some stage, do you have any restructuring in mind for either of these verticals?
So, Aditya, thank you for that question. I think we've stated earlier also that our strategy is to be oncology-focused organization. That's what HCG is synonymous for. That's what is our core competence. We would like to pursue oncology business going forward. Now, as a legacy, we have a few multi-specialty hospitals. Currently, what we are trying to do is see how we can grow oncology specialty business within those multi-specialty hospitals. A good example of that is Bhavnagar. It was a purely multi-specialty hospital with pretty much no oncology business. Last few years, we added a linear accelerator there. We started growing surgical and medical oncology. That specialty is growing there. We will do similar thing at Rajkot. Right now we will focus on, growing the oncology share of business within this hospital. That's what our, current focus is.
So basically, your multi-specialty setups, you're trying to sort of tweak them to be more super specialty within the multi-specialty. Is that how I should read it?
Yeah.
But why not divest those assets really? And
for us in Bhavnagar, so we're trying to replicate that in other locations also.
Yeah, but Raj, you could actually divest those assets. So if you look at the private market transactions in the hospital space, the multiples at which these transactions are happening are far higher than your stock gets. So it is actually going to be value accretive for you if you divest your multi-specialty assets, get the cash, pay off the debt, and use the cash to acquire super specialty oncology assets.
Yeah, this is Ajay Kumar. In this regard, obviously this has been internally discussed quite a few times. But our multi-speciality is very limited. If we have to look at it, diversify and everything, it requires for us to maybe put more emphasis on multi-speciality. Instead of that, we've decided we'll do more speciality. And also we really do not have that much debt. So we are looking at various models. What you have suggested is also has been discussed internally, and obviously we'll continue to discuss. There is as they say, there is a time and place for everything. We'll look at it when the right time and see whether we should do some of these things what you are suggesting also.
Understood, sir. Thank you for that. One last question, sir. On the CVC stake in our company, which is currently, if I'm not mistaken, around 58%. Have they shared any timeline with you as to, how long they plan to hold on to the lion's share of the company, and the fund which has invested in your company, how long will they stay invested, and when do they plan to liquidate, and will the liquidation be one shot or multi-stage, staggered liquidation? How will that work?
Yeah, this discussion has not taken place yet because it's too early, possibly. They have been with us for a little over 2 years now. So obviously, the time horizon will be 5 years or longer for any private equity. So they are, at this point, obviously they have done well, and they have been of continued support to us in our whatever endeavors we have taken. So it is a good partnership, and at this point, we want to really keep that good partnership and grow.
Understood. One last question, Dr. Ajay, for you. So, a lot of the hospitals that we meet and speak to, obviously all of them want to focus on oncology as a specialty, given the growing incidence of the disease and the lack of treatment options available in our country. My question to you is, have you explored the opportunity of doing operating and maintenance contracts with many of these, let's say, standalone hospitals, which might have an oncology wing, but may not be making much money or may not be doing very well in that wing because they just don't have the expertise or the knowledge or the technology to deal with the therapy area. And that could be a very asset-light model for you because it's just knowledge-based revenue. So have you explored such opportunities? If yes, what is the kind of feedback you're getting there? What is the traction in that business model?
Yeah, Aditya, in the past, we have looked at that model. We have also looked at the implant model. To begin with, I would like to say the implant models are not workable for us because we want to be an independent, dedicated cancer center. Mm-hmm. Even the asset-light model, what you talked about, it's not long-lasting. The problem with this is maybe it's the Indian DNA, where the person through which you got the contract at some point would like to say, I know, if we feel like we are doing good, we are generating income, they would like for us to exit. They say we ourselves will do. We have seen that all happen a lot in Apollo model in the past, as you know, where they have been out. So the model we feel just to take a minute and say, strategically there is immense opportunity for us to grow in oncology. And for us, like what we have seen in Jaipur and other areas, where we went into a market relatively competitive, but just establishing a dedicated oncology center, we have grown, Nagpur. So we have this kind of significant opportunities. Also for M&A, we have some opportunities. We are exploring that seriously. So that is the way forward for us, dedicated oncology centers, either through M&A, brownfield, to grow, and also capacity utilization of our own centers. For example, some of our centers, like what we discussed, are capable of increasing the revenue significantly with all the systems we put in place. They are at an inflection point. So our focus will be on that. So our idea is to focus and bring these centers to the level we want. Even our Bangalore center, Whitefield coming up, which will add significantly in the hub and spoke model we have. So there is so much opportunities in strategic areas. We want to focus on that. And of course, our focus is on quality of care to the patient. See, being a dedicated oncology, that is when we can deliver the real quality and real outcomes. So when we look at the clinical acumen we have, the type of doctors we have, 400 doctors across India, and type of service we are doing and outcomes we are producing, research, academic, it has to be a dedicated oncology, like what we have MD Anderson, Sloan Kettering. That is the model we want to drive. And that will give us significant revenue and upside. There is no doubt in my mind. I don't know, investors may have something, but I feel as a founder and entrepreneur, there is absolutely no doubt in my mind how we will grow.
Perfect, sir. Thank you so much for your responses and all the best.
Thank you. The next question is from the line of Sabyasachi Mukherjee from Centrum PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity. I have two questions. First is, if I look at your matured centers revenue profile and EBITDA margin pre-corporate expenses, the EBITDA margin pre-corporate expenses has been stable over the last 6 quarters at close to 25%, right? But if I look at your YOY change in occupancy, that has moved from 57.6 to 65% Q2 FY23, and you have also, I think there is an improvement in ARPOB as well of 5% YOY. Why the margin has not improved? What is the reason behind this?
Yeah. So, Sachin, thank you for that question. As we've been saying, since last quarter, the value creation plan that we have rolled out, we are incurring a one-time cost. Now that cost is, largely allocated to mature centers, in proportion of their revenue contribution to the total revenue. You'll have to take that away to see the impact. That's one explanation. So if you look at, if I am correct, the graphs you are referring to, the quarter-on-quarter trend, you have a 19% growth on revenue, but only 20% growth on EBITDA, right? But if I take away that one-time cost, that 20% will become 26%. So 19% revenue growth is contributing to 26% EBITDA growth for the corresponding period. That's the difference. It's a one-time cost.
Okay. And this you are saying that this will go away in by the end of FY23 and FY24, we'll be able to see the full impact, full benefit of the cost exercise.
Absolutely.
Okay.
Absolutely.
Okay. So, and that benefit would be close to 150 basis points, you are saying. So this 25%, whatever we are seeing in the pre-corporate margins, that will probably move to 26.5 roundabout. Is that understanding correct?
Yeah, roundabout, yes. Yeah.
That's at a network level.
Okay, so 150 basis points you are saying on a network level.
100 to 150 bits at a network level. Yeah.
My other question is related to that only. On the emerging centers, if I heard you correctly, Jaipur has been doing very well, probably operating at more than 20%, or I think I heard you 25% operating margin. Mumbai, Borivali is also operating at a good margin levels. So where do you see the operating margin trajectory of the emerging centers, which is currently at 10% level? Where do you see this going in FY24?
Let me give you a trend to figure out how it will go. 6-7 quarters ago, that was at -8%. Today we are at +10%. So that's the track record we have. And
right.
We will, like I said, we will continue to drive the growth.
So I am aware of the trajectory. It has been, very steep. The point I want to understand here is, I believe the major drag in the emerging centers margin is Kolkata, where you are kind of seeing a 50,000 kind of ARPOB levels, and eventually the emerging centers occupancy has almost touched 70% this quarter. So eventually going ahead, once the occupancy level settles, then probably the margin levels will go up. That is the thought process. So I was coming from there, and that is why the 150 basis points improvement in the network level margins look little conservative, if I say so.
So Sachin, let me clarify. 100 to 150 basis points impact is just on those initiatives that we have launched, right? But we are driving, higher than market revenue at a higher than market growth rate, right? The operating leverage will kick in. So, our endeavor is in next 18 to 24 months. Our endeavor is to get emerging center bucket start coming closer to mature center bucket. That's the aspiration that we are driving for.
Okay, so the total impact in margins would be lot higher, probably in the range of 300 to 400 basis points, right?
That's what we are going for.
Got it. Thank you. That's all from my side.
Thank you. The next question is from the line of Pallavi Deshpande from Sameeksha. Please go ahead.
Yes, sir. Thank you for taking my question. I was just a little late in joining the call. So on the 5 crore one-time expense, if you could just elaborate, who has this been, who is the consultant? And I think you mentioned it will continue in the balance 2 quarters. Is that right?
Yeah. So, Pallavi, thank you for that question. Just to recap, end of last year, we engaged one of the Big Four to start driving operational efficiency. Operational efficiencies on multiple levers. One was strategic pricing based on our market positioning in terms of market share, competitive strength, our internal economics, utilization rates, etc. So that's one component. This is more over and above the inflationary price increase that one takes, every year. Second is staffing productivity, staffing norms, dynamic staffing based on variability in utilization rates in different hospitals across different seasons. Third is the fixed cost that we have, the long trail of items in the midline that we have. Then you have areas of improving, reducing our discounts, revenue assurance, etc. So there are different levers that we are working on with the help of one of the big fours. And we expect that we'll roll out all those initiatives by end of the year, and this cost will go away starting from next year.
All right. So this we can expect a similar cost in the second half, 6 crores, versus what we saw in the first half.
It will start tapering down in the remaining quarters of this year, and it will completely go away by end of this year.
All right, sir. And so secondly, you mentioned about the ARPOBs in the Mumbai property, I think, and by when do we see them, any timeline for it to catch up with what you have at Ahmedabad?
See, that's, ARPOB is a function of the high-end work, complex work that you do, your specialty mix. It's a function of your payer mix. It's a function of your market position where you can command, premium and drive, your mix optimization. That's why these centers are in emerging center bucket. So eventually, it will happen, Anyway, I mean, even if you compare, mid-50s is a good ARPOB, even if you compare it with multi-specialty players. There are not too many players who are more than 60K per day. I think, as the centers matures, it will happen. I'm sure we can give timeline for that. But our endeavor is to go there as soon as possible.
Right. And the South Mumbai lease is for how long for that with the Tata?
So it's another 9 years, but it's mutually renewable.
Right, and so that center only directs the patients to Borivali, right? It's not
No. It has everything and, more than what Borivali has in terms of certain equipment. That's the only other center other than our flagship at Bangalore, which has a cyber knife. It also has Tomo. So in many ways, the radiation technology that we have is best in class in entire Western India.
Right. Okay, sir. Thank you so much, sir.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question. I now hand the conference over to the management for their closing remarks. Over to you, sir.
So once again, I take this opportunity to thank everyone for joining the call. We will keep updating the investor community on regular basis for incremental updates on our company. I hope we've been able to address all your queries. For any further information, kindly get in touch with us or Strategic Growth Advisors, our investor relations advisors. Thank you once again. Have a good day.
Thank you. Ladies and gentlemen, on behalf of Healthcare Global Enterprises Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.